All right. Thanks for joining us, everybody. I appreciate it. And one thing I say at the beginning of all these, one thing is it's being recorded. So watch this again relatively soon after. I'm going to be going over a lot of things, and I've kind of mixed in a lot of different things with this. All right. So I'm trying to make this enjoyable and easy to learn for the beginner, but also for the person that's been trading for a while. I throw some nuggets in there for those guys so that they can learn something from it, and and learning my rules, which aren't readily available out on the interweb or whatever. So pay attention to those, but when you watch it again, it'll be able to sink in a little bit further. And I don't necessarily suggest taking notes the first time, but maybe the second time. It's the first time you're going to have a lot of questions, and when you're trying to write something down, you're going to miss the next step and stuff like that. So, keep that in mind as well. Sooner you watch it, the better you'll remember it. That's the bottom line. You wait a month, it's going to be like learning it all over again. All right, so these are all option strategies for beginner to intermediates. Now, this is going to be stretching on that beginner going into intermediates, only because a lot of the things that I'm going to be adding in here are going to be for some of the experienced traders, where we're going to be talking about some different concepts that might go over some of the newer guys' heads, but watch it again. That's why it's important, especially if you're newer. Watch it again, because by the time it's all said and done, we're going to come back full circle, and you guys will be able to understand it a little bit more. If you watch it again, of course, it's going to be a lot easier. All right, so my name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now, you guys, and so I've been there, done that. I actually started out trading. Oops, sorry, I'm going to shut these doors real quick. I started out trading in college with some money I earned. I worked on different farms and stuff like that ever since I was like 12 years old, trying to make some money. And then when I moved up to when I moved to school, I put money in a bank account, and the bank guy called me up. I was like, hey, you want to invest some of this money into some stocks through our discount brokerage? And I was like, no, I'm not going to. And then I started looking into it and started buying and selling stocks and trying to make some money there, and then got into options. And that's kind of right at the point where I was like, all right, I'm in college for a psychology degree, and all I'm doing is trading. Maybe I should switch this over to finance. And I did. Upon graduating school, I moved up to Chicago and started trading on the floor. I actually started out as a runner. One of these guys running around handing paper into the pits, and then moved up into the pits, sold all my stock, bought a badge, and moved into the pits and started trading. Had some money left over that I used to back myself. So I've been trading my own money for since basically '92. So I've been at it for a while, and in that time I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, basically in all market conditions. So I've seen just about everything except for the like Black Tuesday or Black Monday or something or other. One of those I missed. It was in the 80s. Anyway, any opinions, news, research, and analysis or other information provided by Pro Trader Strategies and associated companies or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of the securities or strategies we're talking about. The reason why is because I don't know your risk parameters. I don't know what's in your portfolios, you guys. So, if I'm talking about this specific strategy, which is the risk reversal today, and it may be very well counterintuitive to your portfolio, where you may be short a stock, and this is going to be shorting that stock even more. So you got to take it, wrap it around. 87, thank you, Black Monday. I had a bit of a brain fart in there. Thanks, Rob. From the UK knew that. So I don't know your risk parameters, so I can't take that into account. And I don't know what's in your portfolio. So, you may be very well tech heavy, and I add more tech to it. So that's why I'm not giving you investment advice. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. So yeah, I started trading in 92. That was 87, so a little bit before my time. All right, so Twitter. You can follow me on Twitter at Wolfman's blog, or follow me on or follow our parent company at ProTrader Strat for different market wisdom and or snark from me. And you can follow me on Twitter, especially right now because we're in earnings season, and this is when I'm going to be tweeting out like my earnings trades. So I'm not going to give the exact strikes because I don't want the entire Twitter sphere to know what my strikes are necessarily. But if you guys are following me on Twitter and you guys have watched the webinars, you know exactly where my strike location is. So it's not too hard to figure out. If I say someone puts in something, you know exactly my strike from watching all those different earnings things. All right, so this is going to be on the risk reversal, and this is going to be on the short risk reversal. There's a long risk reversal and a short risk reversal. The reason why I started out with a short risk reversal on this one is it's very similar to like the collar, where you are hedging a stock in a sense. This is when you put something on later, or you can have a directional assumption with this. But I kind of wanted to play off of the collar that we did a few weeks ago, and kind of we're building on. We're doing building blocks here, right? We started out very simple, and we're starting to add a few things into this. This risk reversal is a little bit, we're going to talk a little bit more in detail than what we were able to with the collar in a sense. So, but this is the short risk reversal, and the short risk reversal really indicates what your directional assumption is, which is a bearish directional assumption. Now, if you wrap this around your stock, let's say, if you're long stock and you do this risk reversal in the stock, what you're really doing is you're capping your upside potential, but you're eliminating your downside risk. And you know, right before this thing started out, I started talking about, you know, Bank of America's market crash indicator. It's imminent market crash indicator or something like that. Well, before this even happened, I was like, hey, you know, we're starting to see the stock market kind of wind up here. We've had almost a parabolic move straight up, you know. The probability to, or the, I'm leaning towards there being at least a bit of a correction to the downside. Whether or not it's 10%, I don't know, you know, but I do feel like we are overdone to the upside. We're even seeing it in earnings. If you guys have been watching my daily market commentaries, you're seeing these guys beat on earnings, but they're tanking like, you know, 10% in a day. You know, and whether it's forward guidance or whatever, you know, they're just they're nitpicking at these earnings to find some bad news in them and sending them down. And that has a tendency to be an indicator at the top as well. And I've had that theory this week talking about it in the daily market commentaries, but, you know, now Bank of America comes out with this. It's called the EER, which is earnings estimate revision ratio, indicates downward move, and it's been right the last like 11 out of 11 times. So there's always that time it could be wrong, but this is for the short. So we're bearish in this unless we have an underlying around it, and then, you know, it's going to be a big problem to have if it rallies up and gets to our out of the money call. Now with the risk reversal, if you're doing this around a stock, okay, I would start out with the out of the money put and the out of the money call that are around, you know, somewhere around a, you know, 20 to 16 delta, probably closer to a 16 delta. You know, I'd like to go a little bit tighter to the market, especially right now. You know, depending on how imminent you think this correction is, you know, the closer you want to go. If you think it's sooner than later, then you want to get tighter to the market, right? If you think it might may not be a very high probability, maybe go a little bit away and you're just kind of looking for that black swan event that you want to protect yourself on. And a black swan event is an event that just almost never happens. So therefore, you know, you would be able to capture to the upside, you know, to the 16 delta and then to the downside, which is going to be painful, but at least it's, you know, like we've seen market crashes before, and a 16 delta, you're counting your lucky stars for being able to get out there then at that point. So basically, if I'm wrapping around this with a stock, I'm going to go a little bit further away to give myself a little breathing room to the upside, and a 16 delta put on the downside. Now, if I'm going to do this as a play or a trade, then I'm probably going to be closer to around the 30 36 delta, maybe the, somewhere between a 36 delta and a 25 delta-ish. It's, and we'll play around with that. I'll show you how we're going to set this up. But on the risk reversal, you usually just kind of pick the 16 delta if it's wrapped around the stock. When we're doing this as a trade, there's a little bit more that goes into it. And you can do this around a portfolio. So I showed this on the collar as well. But if you wanted to take this on your portfolio, and I don't know exactly where the S&P was today. I put this up yesterday where the S&P was trading, or the SPY was trading. So basically you take 1,000, or if you had $100,000, you put whatever your value of your portfolio is in here, and divide that by the SPY times 100. All right. If, basically you can look at this. If you have less than $28,000 in an account, you are probably going to be stuck with doing a one lot to get that to an even number. Right here, it's probably going to be closer to maybe 3 or 4 contracts in the SPY. Now, if you have a bigger account than this, if you're doing this and all of a sudden SPY says you got to do 10 contracts to hedge whatever portfolio value you have, well, which would be like if you had a $300,000 account, this SPY is going to start saying you need to do 10 or 11 contracts, right? Well, the commissions are going to be much greater on SPY 10 contracts than it would be for SPX, which is, $1,000 or basically $1,000 contract, 200 versus $100 contract. This is 283. The SPX is going to be 2,830. Therefore, you're going to save a lot on commissions by just doing a one lot, and you're going to have the same exposure. Okay, so just keeping that in mind. If it starts getting up into the 10s, if it's above 10, you want to switch this to the SPX. Okay, does that make sense to everybody? SPX is a much bigger ETF. All right. So if you get up into 10 contracts, you want to go to SPX for that hedge around an overall portfolio. And one thing to keep in mind, if you're doing this around a portfolio, I forgot to mention, if you're tech heavy, you want to be doing it against the triple Qs, right? If you're very blue chip, you want to do it against the Dow, okay? So make sure you know what's in your stock or in your portfolio. If it's pretty well rounded, then that's why I have a SPY in there, because if you're well rounded, SPY is the best. All right, picking the right underlying. One of the things that I mentioned at the beginning of all of these is one of the things picking the right underlying is knowing what I just told you about. If you're tech heavy in your portfolio, use the Qs. That's one thing to keep in mind here when we're looking at using the right underlying if you're using it as a hedge. But the other thing is picking the right underlying with this is also tight bid ask on the option montage. So hopefully I have a good stock up for the option montage here. Oh, I don't. It's UVXY. So let's just look at something else. Amazon. So, here, let me start out with Deere, $100 stock, a little bit smaller. So my rule of thumb here is 10 cents wide to the bid ask and the option montage on the ones that are 45 days to expiration, or monthlies that are inside of 45 days. Okay, so right here, Deere is really wide, which is a little bit uncharacteristic. Let me try and find something else. Let's just go with XLU. It's a $50 stock, $50 stock, so 10 cents wide to the bid ask. And you can see here to the bid ask, it is inside of 10 cents. Now, in anything that's over $100, we move the decimal 3 ticks to the left, and that's 17 cents. Right now, this is 30 cents. These are 30 cents, but usually they're a little bit tighter. We could look at like UPS. Hopefully UPS has good markets on a Friday after the close. So 13 cents, that doesn't fit that rule either. Nothing's going to work on a $100 stock unless I bet if I throw up Apple up here, it'll work. But tight bid ask, because we're going to be getting in and out of this. And, if the market goes our direction, our puts could be in the money. And when they go in the money, the bid ask gets even wider. is what I'm coming up with there. So $171 stock should be 17 cents wide. You can see these are very tight and inside of that. And usually these other ones will be. This is like during a day session, like, you know, not in the morning before the open or after the close, which this is. Actually after the close, I should say, because in the morning it's usually previous day's prints. But just make sure during the day session they're inside at 10 cents wide. Over $100 stock, just move it 3 ticks to the left. And that is for picking the right underlying. Because everybody can trade like Apple and or there's a lot of people trading Apple, Deere, Caterpillar, things of that nature. Not a lot of people out there trading like Aon or AutoZone and stuff like that in the options. Yes, they have good markets in the stocks, but just not in the options. And that's what we're concerned with here is the options. If you have to give up a big edge to get in, if I have to give up, you know, if the bid ask is 25 cents wide on a $100 stock, let's say, and I got to give up 25 cents to get in, well, if I wait like 10 days, that's about what that theta decay is. You know, if the market didn't even move 25 days later, I'm still looking at buying the offer to get out, which means I took that risk for, you know, a week or so, and I got out for a scratch, and that's not good market trading or good trading rules. So you want to make sure that you can get in and out. Whereas Apple, you know, one day goes by, nothing changes, and I can get out for a scratch, right? Because that 1 day of theta basically lowered by 3 cents or something like that, which is the width of the bid ask. How would this strategy apply if my portfolio is deep in the money calls and puts? Overall portfolio is delta neutral. Do I still hedge the bullish position? Great question. If you are delta neutral, means you have as much exposure to the downside as you do to the upside. You know, if that to me tells me your market assumption is a sideways trending market, right? So if you were leery about the downside, then this would be a trade that you could put on. It is negative delta for sure, but it will protect you on the downside. So it will add a little bit of negative deltas to your portfolio. Does that make sense? And your only risk is up to the calls, but then you have unlimited risk after that because we are going to be naked short calls here in this strategy. So it's not necessarily appropriate for a IRA unless you have that stock in your account in that IRA, right? They're not going to let you, hedge an overall portfolio with a SPY risk reversal and say that that is legit for naked calls in a portfolio, unfortunately. And it's only because they don't know what they're talking about. So picking the right strike, something that goes along with the picking the right strike here. I mentioned this a little bit earlier, the 16 delta, which is a 1 standard deviation. That's if you're basically doing it around a portfolio of stocks and stuff like that. If you're doing it as a trade, I like to move it into around that 30 delta. Remember, I was saying 36 to 25-ish. That's right in there around that 30 delta. So you add up all of these, and that gives you very close to 30%, which is a 30 delta. So we're going to be trying to ping those as well. And there is something I'm going to talk about with this bell curve here in a little bit, but I don't want to get into that too close right now. But if I have it around stock, I'm going to go with the one, which is the 1 standard deviation, which is the 16 delta call and put, actually put and call, and vice versa. If I'm doing this as a trade, I'm going to be shooting for like the 36, right? Now, picking the right duration. Usually when we're doing this stuff for a credit, like I'm going to be collecting a credit for this strategy, it's not going to be much. So it's not enough to worry about it. A lot of things are going on with this strategy. Let me just go over a couple of things. One of them, we all heard about time decay. This is theta decay, okay? This is how theta decay speeds up the closer to expiration happens. Well, one of the beauties with this strategy is we are going to offset some of that theta. We're going to be taking care of the extrinsic value of all of this. The credit we get is extrinsic, and the credit or the debit we're paying is extrinsic. So we're offsetting those. So we don't have a whole lot of theta decay to worry about. You know, if you're collecting 80 some cents or something like that, that would push me closer to here. But most of the times when you're doing this strategy, you're going to only be collecting about, you know, 1 or 2 pennies. So it's not really enough to really worry about there. But when we get deeper and we start collecting, and there's a lot of skew, which I'm going to be talking about here in a minute, and you're collecting a nice big credit, then you're going to want to go a little bit closer to here. If it's closer to 0, then push yourself out a little bit further. You'll be able to get a little bit of a credit for the same thing that you'd get for 0 here. Just play around with it. It's not, since you're offsetting volatility, you're offsetting theta and the extrinsic value, the time isn't as important as with most other strategies, okay? Is this long Vega? No, it's basically going to neutralize Vega. I would, with this one, we're going to be short deltas, and we're not going to be getting long Vega, which is volatility. We're going to actually be neutralizing it. I'll show you that, and theta and things of that nature. So we don't have to worry about the vol as much, and we don't have to worry about it having to be high volatility or low volatility if we are talking about buying Vega and we're buying low volatility expecting it to go higher, or selling volatility and expecting it to go lower, or selling Vega to go lower, depending on what you're talking about there. We're offsetting that, so we don't have to worry about volatility a lot. We don't have to worry about a lot of volatility. We don't have to worry about volatility a lot, I should say. All right, picking the right environment. Now, one of the things with this is what you guys heard me mention skew, and options have skew. And usually they're skewed to the downside or to the put side, where the puts carry more extrinsic value than their counter calls do, right? And that has to do with fear and stuff like that a lot of times, and downside risk and premium, or sorry, why can't I think of it? Dividends, that hard word, dividends and things like that, that creates some of that skew as well. But with this one, we want positive skew, okay? We want the skew to be to the call side. And one of the things with the risk reversal is, they should have called this the Contrarian, because really the best time to set this up is when you are counter the trend, in a sense, or you believe the market is at a top or ready for a correction, or you're worried about that correction, when the rest of the world is you know, happy and wants it to go up. Okay, so you're basically on the other side of that, the Contrarian. Because when the skew is to the call side, it means people are buying up calls more than they're buying puts. And when people are fearful of the downside, they're buying puts and then they're selling calls, in a sense. Well, we're going to be buying puts, so we want to buy those cheaper, and selling calls, so we want to sell those when they're expensive, right? And the only time they're really going to be expensive is when the market is suggesting the underlying is going to go higher. Okay, does that make sense to everybody? I tried to get that as layman as possible. And that's what happens when you have positive skews. The calls are all getting bought up, and you have a long tail and a stumpy one, and then vice versa on the negative skew. All right, knowing our exit strategy before entering the trade. Now, I look at this as the delta. So even if I am going to play this on the 36 delta, I'm looking for it to come down and touch my strike. Now, if you have a lower risk tolerance, that's definitely where you should get out, because this is a low probability trade, has a high risk. So in that, getting comfortable with this strategy, I would say as soon as, if I set this up as a directional bias trade without taking into account anything in my portfolio, as soon as that delta is hit, I'm looking to take profit. I'm looking to take profit. If I'm doing this as an overall hedge, I'm probably going to ride this out a little bit longer, right? Because I've got that 16 delta now if I'm doing an overall hedge. If it goes down to that 16 delta and kind of pierces through that, maybe it's trading, you know, a couple dollars below your 6, I'm going to hold on to this trade because this is becoming my protection for my portfolio, right? So at the end of the day, I'm going to kind of let this ride out because I need that. I need that protection on. It's like, you know, why would you buy insurance when it's cheap and then sell it when your house is on fire? That doesn't make sense, right? You don't get rid of that insurance when the house is on fire because they're not paying you out, right? So, you know, the exit strategy, write it down when you're getting into this. Why did I get into it? I'm doing this for a directional assumption. I think there's a market correction coming. Maybe it's going to be a 10%. You think it's just ready for a 10% correction. You know, that's not going to decimate your portfolio. So you're looking at this as a short bang bang if you get your correction that you're looking for. Then in that case, I would be looking to get out when it got down to my deltas and hit it. If I'm looking at it as insurance for my portfolio because, you know, Bank of America has this great, what did I call that thing? It's so great, I can't remember the name of it. Imminent market crash indicator, the ERR, whatever. You know, maybe you believe in that. Then therefore, I would ride this thing out into the sunset to make sure. And then if you use a technical analysis, you see the market turning, that's when you would get out of it. When the fire trucks have shown up and all it did was burn your grass, you know. Okay, so then take that into account. So this is going to be something you're going to have to play with. If you're using it as a market move, and playing around with it, newer trader, getting kind of your feet wet with maybe synthetic shorts and stuff like that, because this is somewhat similar to a synthetic short. It's very closely related. One would consider it possibly a synthetic short, I'm sure. But because it doesn't have as many deltas, it's not a real synthetic short. So if you're a newer trader, just say, hey, once it hits my strikes, I'm out. If you are more of a veteran trader and you're using like different technical analysis, you think it's going to break down 10%, well, look at that price and that's where you get out, right? That's kind of how I would play it, kind of depending on what you are looking at there. How do you access skew? Looking at your platform. Great question, Kelly. I'm going to talk about that here in just a minute as soon as I get this done and we pull up as a matter of fact, I can pull up the platform right now. All right, so let's look at skew real quick because I'm sure skew is a very difficult, somewhat difficult thing to really wrap your head around, and if you're newer, it is even more difficult. Even veteran traders have difficulty in it. All right, so intrinsic value and extrinsic value. Let's get this out of the way real quick. So intrinsic value is kind of like a way to think about it is like a gold bracelet. All right, you have a gold bracelet, and the intrinsic value of that gold bracelet is really the gold weight itself. The design of that bracelet is extrinsic value, right? It's what kind of beautifies it in a sense. And this is the best example I can come up with just literally off the top of my head. But if you took this to a pawn shop or somebody, you know, that knows value, that person's going to take that bracelet and weigh it and say, this is how much it weighs in gold. That's what I'll pay you for it. Because that's intrinsic value. That's what it's really worth. Everything else is kind of like, you know, it's feelings, which is kind of like what extrinsic value is that's your emotion. So tied to it in a sense. It's kind of maybe a way to think about it as a newer trader. But intrinsic value is its value. Intrinsic value is what this 160 put is worth. So this one, or let's say the 160 call, I should say, because it's intrinsic and extrinsic. Extrinsic. Out of the money options only have extrinsic value. It's all beauty. Intrinsic value is on the in the money options. So if we look at this 160 call, it's got intrinsic and extrinsic value. Well, what's the intrinsic value? Well, if you guys watch a lot of my daily market commentaries, you guys know the floor trader hack, right? If I'm looking at these 160 calls and they're trading 1260, well, what is that intrinsic value? Well, or extrinsic value. You know, how do we figure that out? Well, the floor trader hack is extrinsic value is just right over here. You look at this, okay? Because when we're trying to figure out some of those things for a lot of my other webinars, and I give you guys this floor trader hack, that's the extrinsic value of this. That's not always well and true, and I've talked about this. It could be off by 10, 15, 25 cents sometimes. We're not necessarily always concerned with that on the other strategy. This one, we need to know what our intrinsic and extrinsic value is. So one of the easiest ways to do it, obviously, is take 160 to 171.5. So that's basically $11.50, right? From 160 to 71.5. So $11.50. So we can see that this has extrinsic value of $1 and what is that? What did I say? I'm sorry, 151. So $1.09. Is that right? Did I do that math right? 1150, 109, right? Yeah. So 109. So the extrinsic value is 109. Well, the extrinsic value of these is 122. And that's why I was talking about on a lot of the other trades. We don't really care about that 10 cents. It's not going to make or break us. But on this, when we're trying to figure out skew, if these puts have more extrinsic value than these calls, then that means the skew is to the puts. Okay, does that make sense? The skew is to the puts there. So we could look at something easy, something I've already vetted, to be quite honest. And we look at JP Morgan. So let's look at the let's do the 115 because it'll probably be easier for me to do math on a 15. All right, so the extrinsic value on the puts is $1.34, let's say. It's right in the middle. As a matter of fact, I have this set up on this. I did this on the build out. I did this as a custom and pulled over extrinsic value on the volume and open interest as a cheat for this because I don't want to be doing this on every single trade we look at. So I'm cheating here with the extrinsic value. So here we can see that this extrinsic value is 133, and go over here and figure out the extrinsic value of this. We could cheat and say it's 137. So, but you just figure it out that way, the way I showed you. 115 to 16 is 132. So 132 minus this is $1.37, $1.38 is what I come up with. But they're going from mid-market. So you can see that the skew on this is slightly to the call side because this extrinsic value is higher than this extrinsic value. Now, one thing with this particular strategy, when we're talking about, since puts usually have the skew, all right, because people are buying the puts, it's a rare occurrence to get those calls to have the skew, all right? It's harder to find. I shouldn't say it's rare. It's just much more difficult to find. That anytime you do find that discrimination where you see, okay, the calls have more skew, double check yourself by checking the calls that are out of the money versus the puts that are in the money, just to make sure that skew is still there. Okay, because sometimes you'll see it flip where you won't. It all of a sudden the puts or the calls that are in the money have more extrinsic value than the puts, and then you go up here and all of a sudden the puts will have more extrinsic value than the calls. Now that means it's pretty neutral in a sense. There's a lot of things that go into that type of scenario when that happens, and I don't really want to muddy the waters too much with that. But just know that if you're checking this and all of a sudden you see the puts extrinsic value is much less than the calls extrinsic value, just do yourself a favor and double check that. And that's a way to double check that there. That makes sense? Intrinsic value is the beer. Extrinsic value is the foam on top. I love it. Good call. Kelly and everybody else, when you're looking at this, throw up extrinsic. Just go into customize. You know, EX is what I threw up there, and it might not come up because I've already have it. But extrinsic there, you know, add it over there. Extrinsic. Remove that one. All right. So you can easily compare. So you can just go like this and go boom and boom. You know, 74 cents, 75 cents, and just do it that way. Okay. That way you can get to that point a little bit earlier. I usually don't have it up because I use that cheat. I just look at the 13 puts and go, okay, the calls have 72 cents of extrinsic in it. That's a floor trader hack. Now, when you're doing this strategy, you need to be a little bit more minutia, if you will, on those, on that to figure out real skew. Because if I'm off by a nickel, I'm not going to figure out the skew. All right. So, and I think we've covered the exit strategy. It's going to be more personal, but if you're newer to options, you have a lower tolerance for risk. As soon as my puts are or calls are touched, you know, if it goes against me and my calls are touched, I'm out. If it goes down to my puts touched, I'm out. All right. If you're more of a technical trader, look for a technical support and resistance. When it goes down to your support, you're out. When it goes to your resistance or it goes through your resistance, you're out. Okay. Or trade setup, you know, all those things. Support resistances that you come off of, Fibonacci, value areas, however you come up with your market assumption and where you think that's going to, then stick with that. Write it down. That's another thing I say is anytime we're going through any of this, write down all of your trades. Write down what day you got in, what price you got in, why you made the market assumption that you came up with in order to put on that trade, and then write down your exit strategy. It's really important to write down that exit strategy, guys. I can't emphasize it enough. And the reason why is because if you have it in your head when you're going to get out, and you get to that point where you told yourself you were going to get out, you will have a high likelihood of, I'm going to wait till tomorrow. All right, well, I'm going to wait. And then it's going to go against you. I mean, there's going to be times where it doesn't, okay? And you're going to make money on it. But the times that it doesn't continue to go and snaps back the other way and you go back to not making money on that trade is going to be more often the case than, you know, getting out and saying I left another dime on the table. You know, it's not worth it. Just get out at those levels. Stay with it. It helps you keep mechanical also. And as you're more and more mechanical, you don't even look back. You won't even go back and say, you know, you got out of it. At this point in time in my life, as soon as I get out of a trade, I don't go back and look to see if I made the right choice. I play the probabilities. I'm looking at the probabilities and know that when I beat the probabilities, I beat the probabilities. And yeah, it may have continued and I could have done better, but the probabilities are telling me when I beat them, or I'm making sure that when I beat the probabilities, I'm out. You know, if somebody gave me a 20% chance of winning something, if I won the lottery, I would never play the lottery again, right? What is your chance of winning the lottery again? I mean, you crushed the probabilities. Why do it again? Is it kind of an example of that? All right, so real quick on the risk reversal. Now this is not including the stock. This is strictly a risk reversal based on market assumption. The other, when you wrap this risk reversal around an underlying, it really becomes a collar because you have the underlying asset that you're long and your protection to the downside and your limit to the upside. That's the collar. It's kind of like, hey, you locked yourself in. You're no worse than this point and you're no better than this point and you're happy to be there. But this is when the underlying goes to zero plus or minus any credit or debit. Now, I should just scratch out the debit because I am never going to do this strategy for a debit. All right, I'm only going to do it for a credit. And, you know, when I say a credit, that could be zero, right? 0 to me would be okay to do this, but I'm not going to pay 5 cents to get into this strategy. And especially if you're doing this around an underlying every now and again, you definitely don't want to do this for a debit because that increases the cost basis you paid for it. You know, these 2 or 3 cents that you are doing it for isn't that much, but you know, I have a pretty, I'm pretty headstrong where I don't like to increase cost basis of anything I buy and want to reduce it. So even those couple of pennies make me happy to reduce my cost basis. All right, so then the next thing is our max loss is unlimited. And it's unlimited because we are short a call, right? We're short a call outright, naked, short a call. And that's what makes that risk unlimited to the upside. So keep that in mind. You know, you can define this risk and make it a risk reversal if you're doing this just as a market assumption and go out and, you know, basically do a short call spread. And then, you know, short call spread is how we would write it in the day, short call spread. And then the long put, you can do that too. But keep in mind, that's going to cause your calls to get closer because you're going to have to move this short call down further in order to pay for that put. And I'll talk about all of that here in a minute. You know, we'll talk about that, but just keep in mind. All right, the break even is the short put strike minus the net credit. And I threw that in there, net credit, because I'm not going to do this for net debit. And it's the short put price minus the net credit. Wait, the short put price, my break even should be a plus the net credit because I get a credit that increases my break even from that put strike. But at the end of the day, it is, you know, you're going to be looking at it as that short put strike as your break even. I'm going to have to think about this. I think that's on the collar. All right, let me pull up the platform real quick. Because my break even is really right where I'm at for the most part. The nice thing about this, this is what I wanted to show something is, here, I'll show it up on the Analyze tab when we get there. All right, so what we want is skew. So like we talked about, extrinsic value. First thing we look for the right are we having the right underlying with JP Morgan? It's $116 stock. Are these inside at, you know, 11 cents? Yes, that fits that rule. So this is a good underlying that we could trade. We've already figured out that they're skewed to the one side, right? So we're just, right now, we're kind of thinking we're going to kind of go through our progression of our rules, right? So for the first one was picking the right underlying, okay? So the right underlying, we've got the right options, picking the right strikes. Now we know the skew, one of the things we wanted was picking the right strikes with the environment. I probably should have thrown environment a little bit earlier, which is this whole skew thing. So we know we have skew, so we know we have the right environment. The other thing is we want the right strikes. Now I mentioned, let me throw this up as, actually I don't want that. Let me do the deltas because I think the delta one would be pretty good. Let me just say, sorry, where is that one at? Let me just customize something. So let's just get rid of open interest, volume, and add delta. Let's add delta to that, say okay. Let me go up here, just say customize. Oh, sorry, actually I want to save as, sorry. Save as, save. All right, so I have it. Because when we flip back and forth, sometimes it'll disappear because I want to show you something about theta and everything else. All right, so we've got our extrinsic on both sides, so that makes it easy. We've already looked at this, 135 to 135, it's pretty even, or 133 to 135, so we know there's a little bit of skew, so then we just double check this. This says it's 81 extrinsic and then 84 extrinsic. That's one of those ones where we're talking about they get a little skewy, where it's like there's skew on both sides. So let's look at it here. I got one for you. This is a great one. The VIX. Everybody knows the VIX. You guys want to see some real skew going on. This is skew, right? We got extrinsic value of on these 11 puts of 30 cents, and we go over here to the 11 calls, and it's $2. That's a massive skew. Now this, this is because the VIX is, really low right now, and everybody's waiting for, the next shoe to drop. So they're waiting for the VIX to shoot up. But, for instance, you're looking at something that's trading at $11.08, right? Well, these puts are 20 cents. Now we're talking about doing a risk reversal, and I would never suggest doing this around the VIX because your risk to the upside is way too much. But as an example, we can look at this and say, all right, I'm going to go look at that. Wolfman said around the 30 to 20 some odd delta. Well, we can go all the way out to like the 24, 21 delta here, let's just say, and say we're collecting 40, or let's do the 24 deltas because I said 25. So, and it's a little wide. We can hash that out later. But let's just say I wanted to sell these at like, what's mid-market, 55 cents. Well, so if I rally this up to 55 cents, all right, so I can sell those at 55 cents, and then I can go down here and buy these puts that are actually in the money. Why did that not work out? 55. I shouldn't be getting a 55-cent credit. I'm going to sell those. Let's just do this. All right, so for zero money. So literally, the skew is so much to the upside on this that I am $7 away to the upside on the calls, and I'm in the money on the puts. Does that make sense? You guys see how that skew can like really peel to the call side? And it's obvious on an instrument like the VIX, right? That's pretty obvious to the upside. But this is just as an example of how skew works and when it is at extremes. Like this is extreme to the upside, right? So you'll never find this good of an example, generally speaking. I don't think I've ever seen that good of an example, but that is a really good example of skew. Let's look at another one. So and I usually say at this time, you guys, like, hey, throw out some stocks to me. But because of all this extrinsic, and we have to go through so many steps with this one, I'm going to go through a few that I vetted just to make this more clear. So lows. Now, and you have to have a negative market assumption, all right? So we would have to be pretty bearish on lows to have this. We don't necessarily want to be doing this around earnings, right? Because that is real risky thing to do. So we don't really want earnings in on this. So I'm kind of assuming with the strategy right now that we're not taking into account. There's no earnings. Let's just say there's no earnings. All right. So first thing I always kind of look at, I always start with the puts, just out of habit. So we got 134 to the 106 and then 146. So we're seeing call skew. So then let's go to these 110s. Extrinsic value is 142, so the 110s is 134, so that's consistent. We have skew to the upside. So I'm going to look at the 107, so let's just say it's 108 is where we're at there. I'm going to kind of roll up to like that 25, somewhere between the 25 and 30 delta. So I want to kind of lean towards the, I'm worried about the upside, let's say, so I'm going to lean towards the out. So I've got about 70 cents to spend here, right? To spend on buying some puts. So I can go down here and buy probably these 103s for about that much. It's probably going to come up to zero if I sell those. Why isn't it working? Sell those, buy these. I should be able to get in for right around 71 or 72 cents. Right? Why is that not? Am I doing something wrong here? Oh, because I'm selling both of them. No. I don't know why that's coming out so off. Sell those. Sell those. Buy those. 31-cent credit is not right. I don't know what's wanky here. I don't know why that's coming out. It should be closer to 0, shouldn't it? Am I doing the math right? If I sold these at 70 or 71 and bought these at 71, which is highly unlikely, it's close to, but 71 should be 0. Why is it 31? Even the difference to the bid and ask is not right. Change quantity. There, it's 10 and 10. It should offset. When does the market indeed, or when the market does indeed drop as anticipated, could we buy back the call that we sold to reduce the risk to the upside? I love your thinking, and you absolutely can. And there's actually even another way, and I wasn't going to get into it. I wasn't going to talk about that, but yeah, absolutely. If the market goes in your direction and it comes down there, one thing to do for sure, if you're more of a veteran trader, which you seem to be from your questions you've asked previously, absolutely you could leg out. This is definitely one of those strategies that I say leg out of. Take off that short call. It's gone to 0. It can't help. It's gone to 5 cents or something like that. It can't help you anymore. So get out of it, right? You've made your money on it. The market's going your direction. And now you pretty much have those puts on for free, right? You have no risk anymore to the downside. And then you can ride it into, the end of the day. So absolutely. Great question. So yes. So he was asking if the market goes down and these calls are worth let's say it goes down, $15 or something, you can see those calls are almost worth nothing anymore. To buy these back for 4 cents or something like that, where I collected all 70 cents and that 70 cents paid for this, that means I have these puts on for free, right? So that's a great observation. So anyway, let's just see here. I'm going to sell these and buy these. See if it comes out any better. Why I'm missing something completely that's blowing me away. Why? Oh, I'm getting a 39 cent. How am I getting a 39 cent credit? Anyway, I'm getting a credit for it, which is good. So if I'm getting a 39 cent credit, why wouldn't I just go like this and buy those and get a 16 cent credit? What is going on with that doesn't make sense. I'm sorry, you guys, for this, but this should be closer to 0. I'm just saying. It should be closer to 0. 70 and buying those. So basically, let's just say we're doing this for a 0. And what we then could look at here is going from 107 to 1. What did I have on earlier? 150. I was looking at. Oh, you know why I didn't go out far enough for one? I wanted to go out to these because, time's my friend here. I want the time, since we're offsetting. Let's look at this. Okay, we were talking about volatility. Okay, this is Vega. And we're talking about the theta, which is time decay. If we are to sell, let's say the, the 115s, let's just say we're selling the 115s and that is $8 higher. So $8 lower is the 100s in a sense. So I'm going to be buying these. That is just going to drive me nuts till the cows come home. Because this should be closer to 30 cents. I don't know why. This should be closer to 25 cents really. Selling 30 anyway. So we're selling these at $2.31, buying those. That's 20-cent difference. I should only be getting somewhere between a 20 and 30 cent credit. All right. So, but here's what I wanted to say. Vega here is 19. Okay. So we're selling that volatility and we're buying this volatility that, it's offset. It's by, 3 cents. That's not a whole lot to really worry about. Okay. And then we look at the theta and we look at the theta, the time decay, and it's 3 versus the theta here is 2, which is good because we want theta decay to kind of help us out on this one because we got a credit, right? We don't want it to go against us because we're short this theta of 3 and we're long this theta of 3. So we don't want this to decay. We do want this to decay. So it's going to decay 1 penny faster. Does that make sense? Trying to add stuff in here. And this is like an iron condor. Not really. I can see where you're getting that, where an iron condor, if it stays kind of like right here, it's going to be okay. But the difference here, and here as a matter of fact, I wanted to do this as something for you guys, is let's, what happened? I missed that. So I'm short the calls, long the puts. So let's go to the Analyze tab. That's the best way to see whether or not it looks like an iron condor. And this is what it's going to look like. If it stays right here, we collect our money. Now that's the same idea as with an iron condor, right? It stays anywhere in between our strikes, we collect money. But if it goes too high, that's where we start losing our money. And then if it goes down here below these strikes, that's where we start making our money. So it's downward bearish. And that's what the risk profile looks like. Okay. And an iron condor is going to have limited risk to both directions because you're short a call and short a put. So you want it to stay in between there for sure. But on an iron condor, you aren't going to make any more money above this strike or below this strike. Okay, so that's what it looks like, our risk profile. We need it to go down to start making money. Okay, another thing we can look at is our break evens here. So it's saying that the break even lands right at, should be on the downside, our break even should be to the, we get a 30-cent credit, should be, and we bought those, should be slightly to the upside. And then these should be slightly to the downside right there, or to the further upside, because we got a credit, and that credit adds in there. And oh yeah, it should subtract out. Our break even is below where the underlying is trading because we got a credit. No, it's got to be above, because I bought those. Sorry, I see a bunch of people asking questions. Can we do long calls and short put strategy? Long calls and short put. Absolutely. That would be a long risk reversal. Does that make sense? Don't like going naked calls, especially in a rallying market, OM. and you can define that risk. You know, you can kind of define that risk. And what you could actually do is maybe do a couple of two short call spreads to buy that put. You got defined risk. Of course, it's going to change a risk parameter here, but you can kind of play around with that as well. Does that make sense? With it being after hours, would the thin volume blow out the spreads? Yes, it does. And it also, you know, you can start seeing a lot of these where it, you know, that could be part of the case, but this is way off. This is not even making sense to me for some reason why it's giving me 60 cents when if I sold the bid and bought the offer, the best it could be is 20. And if I did it the other way, if I sold the offer and bought the bid, then that's still not even 60 cents. So I'm just trying to figure out why it's giving me those weird ones. I imagine margin is high in the short call. It is, Neil. Would you ever buy a deep in the money calls when you still? I don't, because I think there's more risk in those deep in the money calls because you're actually paying for the money up front. But here, let's look at this. What I would suggest, if you guys are very concerned about, you know, getting short calls, especially when you're getting closer to the market on this, you could go out and, you know, I've got 30 cents here. I could go out here and buy like the, you know, the 35 calls to define that risk. Now, I would not let myself see that happen. You know, if there's a jump in the market and you don't have a choice, then that's what you're buying that protection for. But, you know, if you're trading this, I would not let it go through to that point where I was using that protection as my out, in a sense. Does that make sense? I can't remember who asked the question about that for the short calls. Neil? You can go out there to find that risk. That will also limit the margin hog that this is. You know, so if you are playing with limited margin, you know, I talk about this with a lot of my, you know, I do short calls in my IRA, synthetic short calls, naked. But it's because I just go out and I buy the first call I can for a nickel just to make the governing powers to be off my back. I buy a call for a nickel, and that way, you know, it's defined risk. No way I'm ever taking it to that one delta strike that I paid a nickel for, but it does define the risk and limits my margin and, you know, doesn't make it illegal in an IRA. That makes sense? So you could do that as well. So like, for instance, if you're getting a 30-cent credit and you're worried about that, go out and buy this call to define that risk. But, you know, you need to be on the trigger. You know, if it comes up and hits these, I'm probably going to be out of this. It's a low probability strategy. The market can go in either direction at any given time. So if I'm wrong and it hits this, I'm out. More delta. Example seems to be better shown right now using SPY. I'll check that in here just a second. Give me a second because we're kind of running out of time. I thought this one was going to be a really good one, but we can look at SPY also. And I got a couple other questions coming up real quick. But thank you, Adam. I appreciate the heads up. All right, so could we take some additional deltas to make the position more delta neutral, even if we are away from the short strike? Yeah, I mean, you can take the deltas away any way you want by buying deltas and things of that nature. You know, I mean, you know, if we're what he's speaking about, and so let's look at SPY and pull up an example since I've got it right here. So we're going to kind of make sure our extrinsic values. I'm going to assume that it is skewed this way. It is. You can see right straight across. It's slightly skewed to the upside. Let me just double check this to that side. SPY is usually skewed to the upside. This one's a little flaky. It's kind of both ways. So it's pretty neutral. So let's just go with it anyway. So I'm going to look for the delta right around the 36 delta. Let's just say start out with that for this one because I'm really bearish now that Bank of America knows what they're talking about. I'm joking on that. So I got $3.20. I'm going to have to look at this one right here for $3.21. So let's buy that one. And that works out, right? Pretty close to it. All right, so and then just look to see how far away we are, 86 to 92. So we've got 6 to the upside and 86 to 78. I'd much rather have that be closer to even to the upside and to the downside. You see what I'm saying? Because 1, 2, 3, 4, 5, and then 1, 2, 3, 4, 5, 6, 7, 8, 9. You know, for me, to the upside, that's, you know, we would rather have like in that one where you're closer here and further away here. That's the real skew to the upside that we want. Or at least even equal distance from the one to the other. Let's look at GDXJ. GDXJ, which is basically the junior gold miners. GDX is the gold miners, so we can look at GDXJ here. And I think that I vetted these, and they had skew 29 to 13, and then here we've got 27 to, did I do that right? 27 to 10. So it skews to the upside here. All right, so let's do this real quick. I'll look at doing the, let's look at the 37. That's a 40 delta. It's a little tight. Let's go to the 35s. All right, so I want to sell those. 126, what does that buy me? The 132s almost, or sorry, the 32s and almost the, so let's go with the 37s. This is close. That makes it really a little more visually accurate. So here you can see we're trading at 35, closer to, 35. So I got 35. So I've got $2.25 to the upside. To the downside, I've got $1.79, right? So it's easier to get to these 33s than it is to the 37s, despite the fact that the deltas don't necessarily show that. The deltas actually show there's a higher probability of getting to these 37s than it is to the 34s. But that's just because the market is predicting a move to the upside in the junior gold miners. It doesn't necessarily mean that's going to happen, but that's what the market sentiment is. And that's what I was talking about. You kind of have to be a contrarian, where you are thinking is going to go the opposite way of what the broader market is kind of telling you. So in that, we're still collecting a credit, but that's when you want to do this, because when you're being the contrarian, you want to be able to get to this strike faster than it can get to this strike. And just by doing math on that, there is a likelihood you could more easily get to this price, despite the fact that the market's skewing it to the upside. Does that make sense for everybody, what I'm saying there? When you can get that skew where you're actually closer to that, you want the ones you're buying to be closer to at the money than the ones you're selling is what it kind of boils down to, that I'm trying to get to. Defined risk takes away from the premium. It does. Defined risk does take away from the premium, and quite dramatically, to be quite honest. So, another thing you could do is double up on selling the short call spreads, if you wanted to do that to get in order to pay for paying that premium. But that's not something I usually do. Yes, Ryan. And Ryan says, how about add more shorts to take in more credit? Love your thinking, Ryan. As a matter of fact, you know what you could do as well, and this is a bit of a skew as well, and I've done this before. I needed to get 160, is to go out, to the 40s and sell these twice. But then you're really increasing your risk to the upside. You need to be pretty bearish on that. But I have done that before, where I'm a little bit worried about it coming up. Maybe this is where the resistance is, or the Fibonacci or something like that. So I'm a little worried about that. Then I've gone out here and said, hey, I'm well above that Fibonacci level. I'm out here. I'm just going to sell these twice and buy this once. So you can play around with these in different ways. So there are, that's the beauty in options, is there's only calls and puts. Everything else is just the iteration. What was it? Broken wing flies on the call side. Can we do this to reduce margin? You could probably do something like that. This would be more, I would be looking at this as being more of, you're looking at kind of like an iron condor rather than a broken wing put or call butterfly, which is just all calls and puts in a sense. But you could do it as like an iron condor or something like that. But, then if you're doing it as an iron condor, iron condor is directionally non-biased, and so is like a butterfly. You don't want it to go outside the wings. We want this to go down and out. Right? We want this to go down as much as we want. And in an iron condor and a broken wing, you can't get, you're looking at like a 10% correction happening. You want a big move to happen. And this does work really well, if you're right, with like UVXY, which is like the leveraged products, TBT, another, it's the triple reversed leveraged TLT. So they do work really well, especially on those type of products, if you put these around those, because they have an outpaced move to one side or the other. Does that make sense for everybody? And so if I have a lower risk tolerance, when it gets down to those 33s, that's probably where I'm going to get out. Now, if my Fibonacci level was here or whatever, or my target was here, then that's probably where I'd get out. Write it down. If I was doing this to hedge my portfolio and it came down and, traded down and through these, and I'm like, oh my God, my portfolio, Well, this is your protection. We did it by the ratio. It's not going to be perfect, but it's going to be pretty close on that little formula I gave you. And then once your calls are relatively worthless, pull the ripcord on them, get out, and ride those puts for free as your protection. And by covering those calls, it will increase your probabilities of success too, by the way. All right, you guys know me. I talk about probabilities. That's what I teach, all right? Or if you've, even if you, this is the first time you've watched one of these videos. I talk about probabilities, increasing probabilities of success and how to manage those. And with this particular strategy we just talked about, somebody mentioned about risk management. You know, if it goes up and touches your calls, there's not a whole lot you can do. You can't roll those puts up because you're basically throwing good money at bad money if you have to roll those up and pay more money for those puts and stuff. I would cover this strategy. That's your risk management. You pull the ripcord. That's your stop. When it hits my calls, I'm out. Pull the ripcord. Done. All right. Or if it reaches a Fibonacci level, that's where you're out. You know, when somebody was mentioning about doing a short call spread because they don't like doing naked calls, then depending on how you set it up, if you do my nickel thing, don't let it go to that nickel and just think you're safe. That's gonna hurt bad. But if you have, you know, $1 wide, then that's not going to be too bad. So, you know, one thing I talk about is, you know, learn as much as you can. And you guys have obviously done that by taking this webinar. But learn as much as you can about options and probabilities and what those probabilities are telling you, because nothing else in my eyes matters other than probabilities. Vegas doesn't give a crud what game you're playing as long as the probabilities are in their favor, right? They don't care if you're playing Apple. They don't care if you're playing Microsoft. They don't play if you're playing, you know, Baccarat or the slots. As long as those odds are in the casino's favor, they don't care what you play. And I'm the same way. I don't care what I play as long as I can, you know, increase my probabilities. And one thing with this strategy is it is a low probability strategy, but we can increase our probabilities by making sure we are exploiting that skew, all right, to the call side. And that's what I try and teach, to increase your probabilities of success. You know, being a technical trader and all those other things are great, but playing the probabilities is ultimately where you guys are going to come out ahead. And it's going to allow you to sleep at night. If you're looking at a Fibonacci and thinking that's going to hold and allow you to sleep at night, it's not. But if you play probabilities and start thinking about, hey, the probability of that happening is only like a 10% chance, then, you know, that gives you a little bit of solace. Or the probabilities of success are like 80%, you know, that gives you a little bit of, you know, love, if you will. The probabilities on this are going to be about, you know, probably closer to 35–40% probability of success. So it's a lower probability strategy. It's in the favor of the other side. But if I'm pretty sure on my directional assumption and my probabilities, it comes down and touches my puts, and knowing this is a low probability strategy and I beat the probabilities, I'm going to get out. Okay? So that's why I'm pretty finicky on that. But anyway, my webinars, I talk about that, how the probabilities gone against us and how to take advantage of that. But this is all about earnings, you guys. And I forgot to put the link in the chat window, which I'll do right now. Send that out to everybody. Give me a second to set this up so I can do this to all the audience. So in the chat window, we've been talking back and forth in this questions box. In the chat window, there's a link to this. If you're watching this tomorrow on replay because you want to watch it again, or you weren't able to attend this webinar but signed up for it, pause it and then just punch this into the URL. There's basically every option strategy that I would do in and around earnings and why I would do those strategies in and around earnings, like the Iron Condor and things of that nature. And when to get in, when to get out, what strike location, all of those goodies for every single strategy I go into in detail. So take advantage of this, especially because we're in the middle of earnings season. This could pay for itself easily. So what do you say? Go ahead and click on that chat window link and you can take advantage of it. All right. One last thing I just want to say is thank you very much for attending this webinar. Later we're going to be drilling down on different options components, how to trade the options, when and where I find them appropriate. This is also the link that you could pause. It's not a hyperlink or anything. And if you have any questions, you can reach out to us at 310-598-6677 or email us at protraderstrategies.com. Yes, Joe, $36 is a deal. Literally, you can make that up on one bad trade in in earnings. I've been directionally wrong on almost every one of my my earnings trades, and I am slightly up money at this point, which is a win in my eyes. I've been directionally wrong on every single trade I put on for earnings. Every single trade I put on for earnings has been directionally wrong on the earnings release, and I'm in positive territory on cash. So I'm very happy with that. How often can you be wrong and still make money, right? Well, with options, especially around earnings, you can, and I talk about all that in this webinar. So that's about it, guys. Anybody else have any other real quick questions that I can go over before we sign off? Appreciate it. Thank you, Chris. I did interrupted too many times for work stuff. That's awesome. Thanks, Chris. Appreciate it. I could see this as a great way to counter move after a pop drop earnings. Thanks for your time. Great webinar. Appreciate it, Adam. Absolutely. This is, when you buy or sell a stock, if you get long or sell or short a stock, your probabilities of success are 50%, right? That's just the way the probabilities work out. One could say in the last 5 years that doesn't work out, but this is over the long haul. If you, on any given day that you go out and buy a stock, it could go up and down from where you bought it from, is what that probability is. So this is, a directional assumption that you think is going to go to the downside. It has a slightly less probability than, say, if you did it right at the money strikes. And the reason why that is because there's that little gap in between. As a matter of fact, if you're collecting a nice little credit for your probabilities are increasing, because then you have room all the way to those calls in order to be wrong because of that credit you collected. But that's at expiration as well. But you do have room to the upside when you collect that credit that increases your probabilities a little bit more. All right. I may have missed the beginning. If you're hedging a portfolio with SPY, do you need to see the skew? The skew just is a little bit more helpful. And it doesn't, if you're hedging a portfolio, I would worry less about the skew, especially if it's only off by a couple of pennies, I would be a little bit more concerned if it was like, the puts were hugely skewed from the calls. And it makes it a little bit more difficult to do this strategy because your puts are so far away, then your calls are closer. But if you're worried about it, it's worth taking that risk as far as I'm concerned. Thank you, Sharon. Kathy says, thanks. Thank you. Our teaching is surprisingly easy to follow for a newbie. Oh, I appreciate that, Kathy. Thank you. I tried to make it easy, and hopefully somebody out there that's a veteran trader will be like, hey, I even learned something from a strategy I already had known about. That's ultimately my goal, is to make it easy enough for the beginners to learn and throw in some nuggets for the guys that actually I can't even pronounce your name. Who is a savvy trader, I can tell, is Charanjit. Did I say that right? Seems to know a lot about options, so hopefully he took something away as well. Yeah, the link is in the chat window over there to the right. You can click on it. Thanks, Ryan. Appreciate it. All right, guys. You guys have a great weekend. That's all I got for you guys. If you can't take that, take it easy. Appreciate it, OM. Take care, guys.